Bob Pisani. To Bob's point, a big decision on rates coming this afternoon from policymakers, plus Fed Chair Powell's news conference. Our next guest does expect 2 cuts this year, beginning in September. Joining us this morning, former Fed Governor Larry Meyer, now chairman of LHMeyer Monetary Policy Analytics. Larry, great to have you. Last few days, we have had some former Fed officials argue that July should be at least live. You're not quite there?
Oh, no. This is not decision day. We call FOMC meetings decision day. This is not a decision day. This is a day for guidance. This is a day to watch the statement and the press conference. And the objective is setting the stage, not starting, setting the stage, and reinforcing market expectations, which strongly expect a September cut.
What kind of pros will convince you that that is exactly what the Fed chair is trying to do?
Well, what they'll be talking about are progress on inflation, additional confidence, the words that suggest they're ready to go. In addition, they'll be talking about the dual mandate, the balance of risk, because they're not only worried about inflation, less so, but they're worried about a unwanted cooling in the labor market. Labor market is fine right now, but that's where the balance of risks are. And the labor market will determine how fast the Fed cuts.
Larry, we waited a long time to see the lags from the higher interest rates. What do the lags look like when the Fed starts cutting?
I think they're the same. It's a year.
In other words, how will they know how many times they need to cut to preserve this soft landing?
You don't know. What they think now is, given their forecast, they think they have to move towards a neutral rate, which is consistent to being at and staying at maximum employment and price stability. That's what models tell you. That's what the judgmental forecast is. And you're responding to the data. The data is telling you you're really right about inflation, and you're right, the labor market is cooling. So everything they're seeing is consistent with their expectations.
So what should they set the stage for beyond a September cut at this point, especially when there's a debate as to what neutral looks like and when they're going to be able to get there?
Right. So first of all, they're not setting the stage, but they're saying something that everybody should and will interpret, that this is not a mid-course correction. This is the beginning of an ongoing easing cycle, and they're searching for neutral, and they don't really know where neutral is. Call it 3 to 4%. To the extent it's 4%, that means slower. To the extent it's 3%, that means somewhat faster. And that means you have to be more cautious. You want to get to 4% by the end of next year, let's say, and then you want to be a little more cautious because you might be where you want. So you look at the data, you look at how the labor market is doing, you look at what's happened to inflation, and neutral is unobservable, and that's always going to be an uncertainty. But we have to see what they think it is.